For turtle soups that are part of an existing price run, anytime you're trading in a fair value gap, you're literally trading a turtle soup. You're trading above and going short an old high, which is this candle's high. So it's not support and resistance that we're trading. We're trading with the express purposes that there's an absence of buyers that's been afforded any opportunity to be a buyer above this candle's high. That's essentially what my fair value gap is doing. So let's do this. The fair value gap is this. We have one single pass. The shaded area is highlighting this candle to that low, that candle, okay? I don't care about anything else except for that candle's low because there's no volume imbalance there. See that? No volume imbalance. We're part of the sell side of the curve. We're dropping. I want to see it stay low. I want to see it stay low. All things being equal, no wick discussion. It's just this fair value gap. What we're talking about is it's part of a sell side delivery. It's part of a sell program. The market's reaching lower for sell side or a discount inefficiency. I took your attention to the midpoint of that 830 gap, which is here. So if it's going to trade up into this inefficiency where only one candle passed, so between this candle's high and that candle's low, it only went down one time in one candle for 1 minute. That's inefficient with buy side. Buy side is where price is offered going up. Buy side liquidity is where it's reaching for while it goes up. See? Buy side liquidity are actual pending orders in the marketplace, either to buy into a new long position or to buy and exit a short position as a stop loss being activated. I'm looking at that high right there, and I want to be a short seller generally on the fair value gap. I'm trying to put my limit order at that price or one tick above it. That's my first 6 contracts. That's my model. And then if it can trade up into the midpoint or as it starts to slide towards it, then I'll throw in my 4 contracts. So what does that give me? It gives me 4 lots. This is where we're eyeballing it and saying, I want to see how it behaves once it trades there. Does it go all the way to the midpoint? Does it go all the way to the top? This is permissible. Remember that term? It's something that is allowed to happen, and it doesn't change the underlying direction or where the market's going to go. It just means that this is possible to happen. It doesn't change anything. It's much better if it only goes to half or less and then does this, because that means it's really, really weak. But because I already expect it to go lower, this is just an opportunity for the market to reprice to that level right there. That candle's low. It doesn't reduce the effectiveness of the trade. It doesn't make it more profitable or less profitable. It just gives me as a emotional and psychological comfort that I am on side. It's going to start really running away quickly after it rolls out of here and doesn't go in the upper half. So meaning this, if it's like this portion, like say it's like that much of the gap, doesn't get traded to, and say this wick only went up to like to here, but left all that shaded area open and not touched that high, and then it did this price action here, that's usually, if you watch my examples, and you'll see me talking about it in real price action when we get through the August content, and then we start looking at minute by minute, second by second candlestick, and then what you're observing, Caleb, what to anticipate, what it should do right now, not the overall grand scheme of how to reprice and where it's going to go and how to behave in those ranges. That's what we're doing right here. This is the beginning point. But I want, if I'm shorting a fair value gap, I want to enter at that old candle high. And by the very nature of it, that's a turtle soup. You're going short above that high. You're trading in an area of inefficiency, and you think this is turtle soup. Just a high, pierce above it, and then there it is. But that is true here. That's a breaker. Breakers tend to be turtle soups in changing directional sustained price runs, where you have high, low, higher high. There's your breaker, but the essence is a turtle soup. That is not what's going on when you're using as a trade entry that's part of an existing or underlying or unfolding sell program or buy program, because you're looking at one single candle like this and you have to get above that candle. Well, how far can it go? It's going to be harder for you to do these entries here, because as it's going up like that, you're not going to want to stand in front of that. Given to you yesterday, and the market goes up into it, trades to it, and then rejects it. It takes a whole lot more understanding and a whole lot more complementary understanding with other PD arrays to do these types of trades, selling right there. But these are the more advanced ones. These are very, very demanding in your understanding. The fair value gap, which many of you are real accustomed to now, you're comfortable with it. What you don't realize is you're doing the same thing here. That high is here. This high is here. The difference is this is a visual aid in telling you how far this part of this run above this old high here, which is this individual candlestick, how far can it go, ICT? Where's too far? Too far is going above this candle's high. That's a stop loss. Entry here. Stop loss here. Now, that's the baseline entry strategy and where stop loss would be. What do we have here? What is that? What's this part right here? Isn't that a wick? Oh. Well, let's use that information, because that candle is the high end of the fair value gap. Pattern is 3 candles. It's this one. That's candle 1. Here's candle 2 and candle 3. A fair value gap, the inefficiency, is always candle number 2, SI. Candle number 1. If candle number 1 has a wick right here underneath it, that is a premium array. That means it's above the fair value gap and it's trading up to here. You're thinking, I'm going to get into a trade here or at the midpoint, and you want to see the upper half of that stay open. That's this area right here. Classic fair value gap, where you start when you're studying this, you want to be observing price action and you don't want to see it trade to this high right here. So entries here, stop losses here. That's the methodology, okay? Advanced version, okay? How do you mitigate underlying risk? How do you reduce risk? How can you use smaller stop losses? How can you make your stop loss really tight like this? Using the stop loss placement, I'm going to show you one element to sometimes, not all the time, there's a lot of things that go on based on individual trades. But initially, Caleb, when you're watching price, not taking trades, you're watching it enter. You're thinking, okay, I want to see it, how it behaves here. If it goes there, I'm expecting it to go halfway, no more, but leave a portion open. But if it goes up there, then you demand immediate response where it needs to drop, okay? If it doesn't completely come back to this candle's low, and it leaves a portion of that open, that's what you want. And then you anticipate very fast speed and big, large range candles going lower. After it trades to that candle's low, like that. Once it does that, then you absolutely demand immediate response, and the same thing happens. In my videos, you'll see me say, I want to see speed and distance and large ranges going down. And then you get it. That's qualifying and quantifying the setup real time as it happens. But what happens if this is a little too rich for you? You don't like that. It's too much range. How can you reduce it? Well, if you have this candlestick number 1 in your fair value gap, if it has a wick like this is a premium array because it's going to be trading up to it. You don't want to see it trade there. But you can take that wick and do this. There's consequent encouragement of that wick, plus 2 ticks. There you go. The market will run up here. At one point, this will be a bold-faced bullish candle. You'll shit yourself, okay? You'll be scared. Some of you watch my live examples of trading, and you watch it and you're thinking, oh man, this is going to get stopped out. And then all of a sudden it doesn't. How do I know that? I'm doing things like this. So by examples of things like this, it affords you better, efficient stop loss placement. You're not fearful. Why would I fear this never being hit? Because it's 2 ticks above the midpoint of this. This candle opens and trades down. Isn't this overlapping that candle's low when it does this? So essentially, what is this area here? It's a balanced price range. Balanced price ranges, we don't ever want to see it go down, start here, go back over, and then come all the way back to the top. If it does that, it's probably going to go higher, and I don't want to be in that trade. So I don't need to put a stop loss up there. I can be just above the consequent encouragement of that wick because it's a gap, just like this is a gap. Okay? So anyway, that's the business there. So now I've taught you how to trade and how to enter trade stop loss and how to also use a very, very small stop loss. I've also taught you today how to anticipate when the market's going to run and be aggressive and start creating large range candles. There's only 2 circumstances that cause that. I taught you both of them today. When you leave a gap opening or if it closes the gap. If you leave a gap opening and it's the upper half when you're bearish or the lower half when you're buying, once it leaves it, it needs to accelerate and move away. But if it goes up and fills the gap in entirely like it does there, it must immediately give you speed and distance in large range candles moving away from it. And then once it takes out this low here, now we're in a new range low. Let me put more data. We were looking for this level here. We had the response as we were looking for it and traded off here. Once it takes out that low, if you see that happening, partial there. Even if you had single contract, partial there, and you screenshot it as it trades below that. And then you watch and observe. How does it behave? How does it behave? Goes up one more time, bumps into it, and drops away. Comes back one more time. I gave you the order block here. So this candlestick, I told you, that's a bearish order block. We have a fair value gap there. I don't want to see it trade above it. And it didn't do it. See that? So if you were going to trade the order block, say that was going to be your methodology, and you were using that here, okay? Where would your stop loss be? If you're looking at this bearish order block, okay, it's part of the run that's going lower, okay? This is the midpoint of that wick at 8:30's candle. We are exploring the likelihood of it trading lower. We're part of a sell program. That means it's going to most likely continue dropping lower. Okay, so it's only coming back to that midpoint to do what? Offer fair value. So if it leaves it like it does here, it starts to trade back up, that right there is your bearish order block. This is where the algorithm gives little, like a mile marker, like a bullet point, or an exit ramp, or a traffic control device. This is where your eye should go to, okay? And that range gives you the levels to trade on. If you have not been a participant of the trade yet, you can use this up close candle to formulate an entry. But where does your stop go? It needs to be above this candle. Okay, it needs to be above it. But where? We have this premium wick. It goes above as the next candle above that bearish order block. Your stop would be right here plus 1 tick. That means you're safe. You're inside of the realm of staying within the context of the sell program. You're above the you're above the bearish order block, and you're encapsulating it based on the wick, because the wick can be if with this like this, okay? There are times where you will see this formation of a up close candle and it drops, and then it'll spike through. And if it does spike through and there's a wick, what it does is it's going right up into half of that wick or just falling short of it. Then if you got stopped out, that's when I'm going to go right back in again. If I missed something down here and I'm seeing price as it's trading up into that wick, okay, I'm going to get short there, trusting that this was the order block and this is where the damage is being done. Don't think for a second the order blocks are always going to be protected. They're not always protected. Sometimes the market will color just outside the lines. There's no perfection, but it doesn't change the underlying narrative. It doesn't disrupt any of that. Now, I'm going to give you one more advanced topic, and then I'm going to close it. There are times when you're anticipating a price run, okay, and it's going to reach for a target. If the market is reaching for these upside targets or downside targets, and it creates the wicks, but doesn't reach the targets, okay, and it starts to create like this reaching element, where it goes up a little bit, comes back down, and goes a little bit higher, and then goes back down. If we anticipate a level, and I'm going to be full disclosure here, I believed at 8:30 that we were going to spike up and hit this new week opening gap. I believed at the time watching it, I believed that that would happen. And it didn't happen right away. It deferred and waited until the opening bell, which is the next expectation, because that's the time elements, right? Well, 8:30, we had a news driver. It failed, okay? If there was no news driver that had like PPI, CPI, FOMC, or non-farm payroll, if those things not being part of the equation, if they're not in the narrative or the day that I'm looking for these types of things, if it does something like this, where it creates a candlestick wick like this, and I believe it's going to trade up here. Remember, CPI, PPI, FOMC, and non-farm payroll, those characteristics that are around those types of reports, they're always manually intervened. The algorithm is being interrupted and disrupted, and there's a hand in the mix, if you will. It'll go just short of where you will go later on when the market opens at 9:30, or it'll go beyond where you thought it was going to go and just keep on going. Those are the two criteria. That's the reason why you have to be very careful on those trading days. The market's going to trade up and try to gravitate towards that. If the market does create this wick, and then the next candle, we start to trade up, okay? But let's just say that I believe that they're going to manipulate price, not because of the 8:30 news, but they're going to leave relative equal highs, or I believe they're going to engineer them, okay? If I believe that, then what I like to look for is this formation. It's the opposite of that, where you're predicting highs, projecting highs with the wicks. Sounds cool, doesn't it? Watch. If we have a day or a session, and I believe that they're going to try to keep highs, if I have an inkling that the market's going to keep a high in place or a low in place, I like to use this concept here, which is the first candlestick that creates that wick here to there. See that? Now, what happens if it falls short of an objective where I'm reaching for? And this is ultimately where I think it's going to trade to, maybe later in the day, at the opening bell or after the opening bell during the opening range, the first 30 minutes between 9:30 and 10 o'clock New York Eastern time. If I think they're going to keep that there, but I'm scalping because I can buy long and sell short in the same day and go back and forth like I was talking about yesterday, I want to be in a market environment that creates and promotes those opportunities. If it's just one-sidedness and it's real lethargic and choppy back and forth, but real tight ranges, but still drifting higher, I'll leave that to somebody else to trade that. So if those instances are there, and I believe that the range is going to stay intact and they're not going to trade to an objective. In other words, I believe that they're engineering liquidity, meaning you didn't know about new week opening gaps and started talking about it. So imagine a time before you learned about them. You might be thinking when this candle was bold-faced bullish, wow, it's going to keep going higher. Who knows where it's going to go, right? Well, if I believe that they're going to hold that range and use this objective later in the day, post 9:30 opening bell, and I start to see a candlestick do this, and I'm long, say I'm long in a scalp. Once it creates this, I want to see, it's still likely to go here. I might be wrong. So I'm going to give it a chance to go one more time to reach for it. If that's the case, then I can take this range here, and it's going to do the opposite. It's the mirror image of what this was doing, where we create the high wick, okay, and it's trading half of this wick here, but this wick and then half of it. It just falls short of half of that. That's reasonable. But what happens when you anticipate a range staying intact and it not breaching it or trading to an objective because they're engineering liquidity? They're deferring a run to a particular price level, but you're in a trade or you're watching price action It's really fun to do this. You see a candle create this initial wick, then the next candle, it starts running above it. What's that candle's high? 19,149 even, right? That's what you're seeing right here. This is half of this candle's wick that has yet to form. Tell me how this is buying and selling pressure. How the fuck is that just going to just be like that? Wicks do the damage, but it's controlled demolition. It's controlled. They're only going to do what it's coded to do until they manually intervene. And when they do that, everything goes off the table, out the window. Don't trade. Simply sit still. I taught you today 2 forms of turtle soup, real one, not Wish version, not the Street Smarts version, okay? But this one here is going to require you to understand a whole lot more because it's going to be very difficult for you to sell short as it's raging into that. I taught the only 2 elements of turtle soup there is, okay? Buying below old lows or selling above old highs. There's only 2 forms of that. It's trade direction and change in a state of delivery, which is, this is a turtle soup for that. It's not the Street Smarts version of it. I just like the name. So if you know that this is a likely upside objective, well, that means when I start the day at 8:30, when I was watching this, I wanted to see it trade up there right at the 8:30. If it would have done that, hit it, and then at 9:30 went above it and then failed, I would have expected something like this at 9:30 opening bell, because it would have traded to the objective I gave you yesterday, and it did it on the first leg at 8:30 and then left that smooth like that, real easy, didn't go above it at all. Then at 9:30, if it would have poked above it one more time, that would have been a turtle soup, and I would have said right here, screenshot that while it's bold-faced up, and then when it's dropping down, I'd say that's exactly what the turtle soup looks like as it forms like this. In your charts annotated or on a notepad, if you don't know where it's likely to be drawing to next, do not give yourself the open invitation to go out and simply trade because now the markets are trading. You have to exercise a great deal of discipline and be responsible. Now, I have a lot of experience. I've been doing it for a long time. There may be moments where I don't have a bias. And I've shown this in my mentorship when I was doing live streams for them. That was part of the mentorship. I would tell them, okay, I don't hold a hard bias right now. So I want to see what we were going to get at the opening bell. I want to see how they use the opening range between 9:30 and 10 o'clock. Okay. What I'm saying is I'm not holding a bias that I can trust that's going to lend to, it's going to draw higher to this premium array, or it's going to draw lower to this discount array. I don't know which direction it wants to do at the moment before the session starts. And then when I look at the opening range, then it gives me more information. Then I can say, okay, well, they made this area jagged. So then I'm going to look for something that's a smooth area. Or if it's a high impact news driver, then it's going to be what? It's going to be the liquidity below that. So we don't need to see a relative equal high or relative equal low when there's a CPI number, PPI number, or FOMC, or non-farm payroll. Those are the characteristics that you do after the report. You look at how they're going to come back on the individuals that would have made money on that run. This is a day I would not be interested if it just keeps grinding higher. I won't chase that. I won't worry about it. And then I want to be a part of a day that has like this. Like we had really nice. We had the mess here first. Then it went up to where I was telling you yesterday. It went to it perfectly. Then we watched this area here. It didn't give me an entry if I would have used it because it's not inside the fair value gap. It wasn't booking that price. But the logic was it should move from here down to the midpoint of this wick. We watched it happen. In this fair value gap, it traded up into that, and it returned back to the 6 o'clock opening price, which is not on here anymore. But we went to the next quadrant level here, which is the lower quarter, and then the low. And then we would be attacking the liquidity resting below that. And then I gave you measurement strategies on how to take the high, the low, whatever the quarter percentage of that range is, projected below that low. That's a pretty good ballpark figure. It's not going to give you the lowest low, but it's going to give you something that you can be happy with. And then We get all this range back all the way up. It pierces this high, and then we broke right back down. And where does it trade to? Look at the bodies of that candles right there. Look at that. You think that's random? Boom. Swept it, and now we're just gyrating around. I would not be interested in trading anymore today.